Okay, welcome to the October 18th edition of the Fats, Fuels, and Oils webinar. As you can see, I'm finally back home and mostly back to normal. I apologize that I didn't get a report published last week. I really wanted to and tried, and between contractors and adjusters last week just kind of got away from me. So I apologize for that, but that will be the last hurricane excuse that I use. And so we should be back to normal going forward. All right, so this week we're going to talk about kind of the usual stuff. We got a WASDE report, we got a NOPA crush report, and then we're going to talk a little bit about the biofuel margins, and we're also going to talk a little bit about the EIA's short-term energy outlook that just came out recently. I think it was on the 6th. I know Bob Lane wrote a bit about it in the daily biodiesel bulletin, but I wanted to talk a little bit more about it here because I think that it helps explain a little bit about what's going on in the RIN market. Anyway, all right, let's start with the WASDE report. And then we'll go from there. So the biggest surprise probably in the WASDE report was a larger than expected cut in US soybean yields, which reduced the crop size. However, kind of like we thought, USDA didn't take that reduction or didn't translate that reduction into lower crush. In fact, USDA raised its crush slightly and lowered its export forecast based on the smaller crop. A significant portion of the decrease in production in the October WASDE was offset by the larger carry-in from the end of September grain stocks report. So the impact of the change in the production forecast was mitigated somewhat by the larger carry-in. However, still, it was the second month in a row that USDA made a relatively significant cut to its US soybean yield estimate. And there's an old adage that says, you know, big crops get bigger. Doesn't necessarily translate on the other side, but I think that there is some chance that obviously that USDA will continue to reduce its yield forecast. Harvest progress is accelerated in recent weeks, but there's still a fair way to go. And so it wouldn't necessarily be surprising if ultimately USDA didn't reduce its estimate of the crop a little bit further. Now, that said, I still think that they will prefer to keep crush higher and take most, if not all, of the reduction in future reduction in crop size out of exports. So I don't think that a smaller crop necessarily has a substantial impact on the soybean oil balance sheet. But with that said, the NOPA crush report that we got earlier this week may change that. Now, okay, so let's just kind of go through the changes that USDA made in their October WASDE in the US soybean oil balance sheet. You can see most of the adjustments really were to old crop 21-22, and that's mostly just to kind of true things up with where the data is headed. We've got nearly all of the data for 21-22, and so at this point, it becomes less a forecast and much more of a, okay, well, we only have 1 month of data left. How much can that vary one way or the other? And sometimes it can vary a lot, but in general, you're just kind of trying to narrow in on where things are going to end. So you can see the vast majority of the changes were on the old crop side. On the new crop side, the increase in crush did raise production. Most of that was offset by a reduction in USDA's 21-22 ending stocks estimate, which I think was further reduced by the NOPA crush report. Outside of that, they didn't really make any changes, and they let the remaining 20 million pounds of additional production fall to their new crop ending stocks forecast. So in general, not a lot of new news in the WASDE report, just based on the idea that at this point, the information that you're getting about the old crop isn't really that germane to what's going on in the markets. Again, now that said, the NOPA crush report for September, which is the first month of the 22-23 marketing year for grains, but the last month of the 21-22 marketing year for veg oils and protein meals, came in below market expectations. And beyond that, and kind of surprisingly, they reported a reduction in soybean oil stocks. Now, at an initial glance, that's really bullish, and the market has reacted to that, and it's gone up a couple of cents, or 2.5 cents almost, over the last 2 days, partially because of the NOPA crush report and the kind of surprise decrease in ending stocks, which basically implied that the 21-22 ending stocks will be really close to 2 billion pounds. We've got them at like 1.999 billion pounds. So USDA probably will need to cut their ending stocks in the November WASDE, cut their 21-22 ending stocks in the November WASDE. However, when you start to look at why stocks came in below expectations and why they fell month over month, it had less to do with really strong demand, although demand is still pretty robust, but it had more to do with the lower than expected crush. Given the crush margins and our expectations for soybean meal demand, the lower than expected crush is a little surprising and a little worrying from the perspective of our forecast for soybean oil stocks through the first half of 22-23 was largely driven by the idea that soybean meal demand is pretty strong. We're not yet at the point where crushers are crushing for oil. They're still crushing for meal. And so they were going to crush for that meal, and then that would end up building soybean oil stocks year over year. Just this report has basically taken all of the growth, all of the year over year growth in soybean oil stocks out of our forecast through the first quarter of 2023, through the first quarter of the calendar year 2023. And so even though the decrease in stocks wasn't driven by some huge surge in domestic use or some big surge in exports, or from the demand side, it's still, I think, can be viewed as bullish just because of that reduction in expected stocks. I think a lot of people expected that stocks would build at least through the first quarter of 2023. and then they would start to tighten kind of dramatically through the second half of the year as renewable diesel capacity expands and renewable diesel production starts to take off. And so the NOPA report kind of said that the underlying assumption that soybean meal demand is really strong and that's going to build soybean oil stocks may not be true. Now, it's not like soybean meal demand fell off a cliff. If you look at average daily usage, it was still about 100,000 short tons a day, which historically is relatively high. 2021 or 21-22 was the first year that the average daily usage for each month was above 100,000 tons, at least based on the initial data from NOPA. And so it's not like I expect that the trend in soybean meal demand is completely going to be the opposite of what I was expecting. It's much more like, well, I had expected a little bit stronger demand. It didn't come in quite as strong as I had expected. We'll have to wait to see what USDA says when they release their fats and oils report, because there are times that the difference between the NOPA stocks and the USDA stocks is pretty significant. So it may be that that the soybean oil stocks are a little bit higher than the NOPA stocks indicated, but on the meal side, similarly, we'll want to make sure that whatever we thought for September demand based on the NOPA data is actually confirmed by USDA. But then two, what happens the next month? The first month of sort of a miss in the meal demand isn't enough to make me go back and rethink all of my meal projections, but it is enough to say that I guess I feel like there's a better chance than I would have thought before the NOPA report that maybe meal demand isn't going to be quite as strong in 22-23 as I thought it would be. And I say all that because really crushing margins were pretty robust throughout the month. They're really high historically comparatively. I mean, if nearby crush is around $2 or even $1.75, that's still sort of 75 cents a bushel above the historical margin. I understand that a lot of the costs have probably gone up around crushing that aren't reflected in just the cost of soybeans and the revenue from the products. And so $1.75 today is not what it was a year or two ago. But still, they're high enough that the crushers probably crushed as much as they needed to meet the meal demand. And again, that's probably, at least in September, it looks like that's probably a little bit lower than we expected. On the soybean oil demand side, if you look at the implied domestic usage and implied non-biofuel usage, based on the NOPA data and sort of our assumption of the conversion of NOPA data to USDA data, both of those were generally within the range of usage that we've seen through the marketing year. Neither particularly stood out for being unusually high or unusually low. We're still waiting on the data from the EIA for August to tell us what non-biofuel demand it was in August, but it was particularly this moment based on our assumptions for soybean oil use in biofuel production. Non-biofuel demand looked particularly strong in August, which typically means either that biofuel is going to be a bit above our expectation or exports are going to be a bit above our expectation. I don't think it's the export thing, but I do think that there's some chance, especially given that the last set of EIA data featured soybean oil feedstock use that was about 50 million pounds above our prediction. So while on the face of it, the NOPA report was bullish, and the market probably is going to run up to at least the higher end of the recent range. I think ultimately what we're going to find is that maybe it's not quite as bullish as it appeared to be initially. We'll see how that works out in a couple of weeks when we get the NAS data, but that's my gut feeling, at least from the analysis that I've been able to do so far. It's not always turn out that way, and now that I've said it, probably will go the other way, but that's neither here nor there. All right, on to canola. This month, USDA adjusted their canola acreage and production forecast and raised U.S. acreage planted and harvested by about 250,000 acres. And that led to an increase in production of just under 350 million pounds. That also took the yield down just a little bit. The yield thing is relatively unimportant, other than just in terms of trend line. And if you think back to what this summer's weather was like, the yield probably fits pretty well within the context of what you would expect given the weather that we saw in the Northern Plains and Canadian prairies this summer. So they had an increase in production, and they offset that with a bit of an increase in crush, and then also a bit of an increase in U.S. canola seed exports. That increase in crush turned into a modest increase, honestly, in production that they offset with mostly with a change in their forecast of biofuel demand. We're still obviously waiting on the EPA to approve or to make a formal approval of the canola oil pathway for renewable diesel, and we still expect that to happen before the end of the year. Once that happens, we'll start to get a sense of how much canola oil is going to be used in renewable diesel production. We actually have it down a little bit year over year from 21-22 to 22-23. However, I think once we start to get data from the EIA on canola oil usage, that number probably comes up, and we probably will end up being a little bit closer to where USDA is. USDA is kind of almost flat, just a little bit of growth from 21-22 to 22-23 for biofuel use. Canola oil is obviously the most expensive oil, or I guess it's more expensive relative to soybean oil, and so there are only certain areas that I think canola oil is really going to work as a feedstock in the U.S., primarily along the West Coast, although there are probably opportunistic, there are times that it works opportunistically in other regions of the country, but all of that doesn't really, I don't think, add up to a significant increase in canola oil use in biofuel production. I think really canola oil's job in this transformation is to, again, fill in for or substitute for soybean oil as soybean oil use in biofuel production ramps up, and leave some of the food industry potentially a little bit short, or I guess more accurately, as soybean oil use as a feedstock grows, then the price rises and canola oil becomes more competitive. Generally, consumers, it depends on the exact application, but consumers prefer canola oil for a lot of things because it's healthier for the heart than soybean oil, at least in some cases, I think. And so I think that while the the approval of the RIN pathway will be important, and the initial data from the EIA on canola oil use in renewable diesel production will give us a good indication, or at least a good starting point of what canola oil demand, feedstock demand is going to look like. I really am more focused on what non-biofuel demand is doing and making sure that that I understand how that's going to work in trying to project that I am focused on the renewable fuel side for canola oil. Again, for the old crop, the 21-22 estimates, USDA is mostly kind of truing up to where it looks like the marketing year is going to end, and didn't make huge changes anyway. But those are changes that I think, again, probably don't have a significant impact on prices. The one thing, the last thing that I want to say about canola oil is that the spread between our assessment of canola oil prices in Los Angeles and crude degummed prices in Central Illinois, which I realize is not a great comparison. It's RBD versus crude in Los Angeles versus Central Illinois, but it's the data that we have to work with. That spread continues to be about 20 cents a pound. And that is what we had predicted the 22-23 average would be. The 21-22 average was closer to 25 cents a pound. And we thought that we probably would get it to narrow by maybe about 5 cents a pound over the course of the marketing year. The fact that we've dropped that fast this quickly suggests that maybe canola oil, that gap will continue to narrow, and canola oil will become more competitive with soybean oil more quickly than we had anticipated. If that does happen, obviously we'll lower our forecast, but I think that there's a chance that in particular, if soybean oil remains as profitable as a feedstock as it has been recently, and if both biodiesel and renewable diesel margins remain as strong as they have been, then I think that there's a good chance that soybean oil use as a biofuel feedstock probably gets stronger. And obviously we have growth built into our forecast, but maybe even exceeds our projections. And if that happens, then that spread probably to canola oil kind of continues to narrow until the point that, again, canola oil really starts to work in the food industry, and at which point then the spread as non-biofuel demand rises, the spread probably kind of stabilizes. So I say all that to kind of say that even though I don't think that we are predicting really aggressive canola oil prices, there may be some further downside to our canola oil outlook, just based on the idea that that spread could continue to narrow, and it just has it narrowed much more quickly than we expected it to at this point in the marketing year. For Canada, USDA really didn't make any changes to its canola oil balance sheets. It did make some changes to its Canadian canola supply and demand, but not really that many. They just cut their estimate of the Canadian crop by 500,000 tons to 19.5 million tons. That is 401,000 tons above Stats Canada's latest estimate, 250,000 tons above our latest estimate. They took all of that out of exports, again, sort of continuing the theme across all of the veg oils, at least in North America, where crush is going to be favored over exports in basically every market. And that leaves most of their forecasts basically kind of in line with where we are. The biggest difference really is in the ending stocks number. So they expect ending stocks to build to 2 million pounds or 2 million tons. I've got to say that even though the last couple of years stocks have come in higher than we had expected, I don't know that I can really get to a spot where I think that Canadian canola stocks grow to 2 million tons unless the crop is significantly bigger than Stats Canada's last estimate, or than our estimate or USDA's estimate even. I think it would have to get pretty close to 20 million tons before, at least before you could get to 2 million. And even then, I think it would be difficult, because I think that if there are, I think any increase in supply is just going to lead to an increase in seed exports, particularly to China, because they will love to crush the seed and get the oil out of it. So I think USDA might be a little bit high there, but we don't have a lot of significant differences with them outside of that number. And the reason that they have that number, that their number can be so high, is essentially there's a residual number for Canadian canola seed, and as you can see, our residual number is significantly higher than USDA's, but it's not out of line with last year's. It's a little bit high relative to the long-term average, but again, it's not super far out of the long-term average. And so I think that I view that as kind of a buffer, or maybe a spot where if exports come in a little bit stronger, I can take out of residual and leave my my ending stocks forecast relatively unchanged, at least until we get a stocks report or two for 22-23, and we can kind of see where stocks are relative to prior years, and get a better sense of where we think ending stocks are going to be. All right, for palm oil prices have, I wrote this week, I think that palm oil prices were up marginally for the week, and that was true just sort of Monday to Monday. But the last couple of days, palm oil prices have kind of ripped higher and are basically back, sort of challenging the 4,000 ringgit level again. And I wrote a bit about the potential for prices in December and in January to maintain that 4,000 ringgit level. Basically, palm oil has moved on the strength in soybean oil, and the spread between palm oil and soybean oil, or soybean oil and palm oil, has sort of flattened out. And so the nearby contract is kind of flat around 30 cents, and then the forward contracts are relatively flat over the last couple of weeks at levels that are a bit lower than that, going down to kind of the mid to low 20-cent range, depending how far forward you go out on the curve. And that all makes sense, and I think that we probably will see that that spread narrow as we go forward. However, the one thing that concerns me about our outlook, and that I think potentially may change in the coming weeks or months, is that if palm oil exports don't pick up out of Malaysia in particular, then you have a situation where you could argue that stocks will build from the 2.3 million tons that the MPOB reported for the end of the 21-22 marketing year. And if you build a lot from that level, you start to get up to sort of record carry out. And in fact, if I pull up the USDA comparison, not that people really pay a lot of attention to the USDA numbers for palm oil, but if you look at what USDA has done, they built a case where palm oil stocks rise to 2.8 million tons at the end of 22-23. Now, I don't think that there's, I think the probability that that happens is really, really, really small. I think stocks probably are relatively level, but for stocks not to grow year over year, I think would either require production to be below our expectations or exports to be above our expectations. And at least through the first 15 days of October, which are literally the first 15 days of the marketing year, Malaysian palm oil shipments had fallen relative to the same period in September. There was a pretty wide spread in the cargo surveyor data. It kind of varied from down 1% to down 14%. So we cut our forecast for October by 225,000 tons, but we also cut our marketing year forecast by 250,000 tons. And even with that reduction, there still is, if you just look at the monthly exports, there still probably is a little bit of fat in the monthly export outlook that could potentially come out. So I think that there is some chance that, okay, maybe stocks do kind of build, but I think you have to think through what happens if exports remain kind of weaker or at or below the level that we're projecting through the entire marketing year. If that happens, then you probably also get a reduction in palm oil production because while palm oil prices are relatively high right now, if export demand is low and you start to build stocks from 2.3 million tons, palm oil prices may not, back to the plantation level, may not sort of justify getting as much of the palm fruit out of the trees as they would if export demand was really strong. I'm not saying that that for sure will happen, and given the fact that a lot of these plantations have struggled over the last couple of years with the pandemic and with trying to get enough labor in to harvest the palms, it may be that they just produce as much as they can just to kind of try to make up for the challenges that they faced in the last couple of years. This year with additional production, even if it is at a little bit lower price level. But I think that generally what I would think is that if you're going to start to build stocks from 2.3 million tons, one, it's probably going to be really tough for the December and January contracts to go out at 4,000 ringgit or so. But two, beyond that, that it may be that production falls from our expectations, or the year-over-year growth that we have built into our balance sheet isn't as strong as won't be realized, I guess. Either way, I just think that it's probably difficult to get to 2.8 million tons, but given the level of prices and the fact that Indonesia remains relatively aggressive with their export program and their policies to support their export program, it may be that that Malaysian exports do end up a little bit weaker. Production does end up where we are, maybe even a little bit stronger, and we do get to that level. I just think that it's a relatively low probability event, and there probably is a better chance that stocks end up a little bit lower than our forecast than they end up a little bit higher. Now, all of that said, that will all also depend a lot on what happens with the spreads. If the spreads really don't narrow, then I think that at some point you are going to start to see some substitution of soybean oil with palm oil, even though we haven't seen as much of it yet as we would have thought we would. I still think that at 30 cents, that seems awfully attractive. Next week, what I'm going to focus on is what's going on in the US palm oil market, because much in the same way that we think canola oil substitutes for soybean oil in the food industry, we think palm oil substitutes for soybean oil in the feed industry. And so I'm going to start to add more coverage of the US supply and demand in our forecast for US supply and demand, palm oil supply and demand in the coming weeks, and then carry that on so that we do that on a pretty regular basis, because I think that development is going to be one of the keys to solving the feedstock puzzle. If you're trying to figure out how to get all of the feedstocks that we need for biofuels, that is going to be one of the keys. All right, I just will kind of quickly talk about choice weight grease. That's what I wrote about this week. Choice weight grease production remains robust this year because yields have been much higher. And in the article, I talk a lot about what's going on, what has happened with yields this year and how that's impacted production. And I also talk about sort of what we expect for yields in the coming years, because yields were really low in 2021, and then rose in 21, 22. 21, 22. We're not predicting that they remain as high as they were in 21, 22 going forward, but we wouldn't necessarily be surprised if that didn't happen. One of the things that I think is really interesting about this is that if you look at the average hog weights, actually fell in 21, 22 to a fairly low level, to around 270 pounds a hog, which is at the lower end of the historical range. And yet choice weight grease yields went up. I still think that is primarily a function of the value of choice weight grease. And so we've got a rebound in hog weights built into our forecast for next year. And I think in theory, I don't know enough about hog physiology, I guess. But I think in theory, a heavier hog should have more fat on it. And so it should mean that there is better choice weight grease production. However, if you look at a scatter of hog weights in yields, that doesn't necessarily bear out. But I think, again, sort of given I think about it sort of in the same way that I think about soybean oil yields. Yes, soybean oil yields are impacted by the weather during the pod filling portion of the crop development. But I also think that crushers are doing everything they can right now to recover every drop of oil that they can out of a bushel of soybeans. And I think that hog slaughterers are doing something very similar with choice weight grease. And if hog weights go up, I would think that that the yield per head would also go up. So it'll be interesting, I think, to see, one, if the weights do go up, and then if the weights go up, what happens to yields. If yields come in higher than we expect, then our choice weight grease production forecast for 22, 23 could be adjusted significantly higher. 21, 22 was basically a record, and we've got a record just slightly more in 22, 23. But that might turn into something that's significantly higher. Now, in choice weight grease, we haven't seen the same thing that we've seen in a lot of the other fats and greases, where we've seen big increases in demand from the biofuel industry. In fact, year over year, choice weight grease use has actually gone down for all for biodiesel, renewable diesel, and co-processing combined. Not by a huge amount, but we're not talking billions of pounds of choice weight grease anyway. It's gone from 700 and some odd million pounds to 675 or 680 million pounds. So not a significant decrease, but it kind of stands out as one of the few fats and greases where we actually have seen a decrease in feedstock demand. I think that's partially due to strong competition for choice white grease, and also at least recently, the relative competitiveness of vegetable oils and the ability of biodiesel producers or renewable diesel producers to use soybean oil or canola oil, make good margins, and have a really steady and consistent supply. Not that you can't get that with choice white grease, but the supply of soybean oil is so much larger that I think it's maybe just a little bit easier to get it with the vegetable oils. And if your profits are the same with vegetable oils as they are with choice white grease, including the value of the credits, it may be easier to set up your operation around sort of a steady stream of soybean oil, at least for as long as it's going to remain as profitable as it has been, as opposed to using choice white grease. And we've got a bit of an increase built into our 22-23 forecast for choice white grease in biofuel feedstock demand, but not a huge increase like we have in some things. And it wouldn't be that surprising to me if the increase was really small, or if demand remained relatively steady year over year. From a pricing perspective, you can see that we've got a little bit of seasonality built in, with prices going up into the end of the year before kind of tailing off a little bit. I think that the decline is on a relative basis is smaller than it probably is sort of for vegetable oils, or maybe even some of the other fats and greases. That's primarily due to the fact that because the biofuel demand for choice white grease is a smaller portion of the overall demand than it is for a lot of the other vegetable oils and fats and greases, it's not quite as impacted by that section of the that part of demand. I didn't say that well. By the biofuel feedstock demand doesn't influence the price as much as it does in other commodities. Okay, on to biodiesel. Let's run through gross margins. Gross margin shot up again last week, and if you look at the value with credits, our estimate of biodiesel rose to a record $1.38. Renewable diesel also shot up, and that was really primarily on the back of strength in fuel prices, particularly in renewable diesel. And what I talked a lot about this week was what could potentially happen in renewable diesel, and how we expect that renewable diesel prices, at least in the West Coast markets, particularly California, probably will remain relatively strong, just because the LCFS credit value has fallen so much that that producers aren't going to be sort of over shipping into the California market. And we're getting down to levels where for some producers that were able to ship into the California market, it doesn't make sense for them to do that now at current LCFS credit values. And so I think that probably helps support the renewable diesel price a little bit in California, or a little bit more than it does the biodiesel price in California, but not enough so that LCFS credit prices start to come back up. I think producers probably will ship just enough renewable diesel and biodiesel or biomass-based diesel into the California market that the LCFS credit is worth the sort of the average marginal transportation cost of the fuel into that market. I think that's around $50. We did see a little rise in LCFS credit prices this past week, but they still remain below 70 and kind of are trading in the sort of $65 area. And we kind of expect that that will continue through the end of the year, but then in 22 or 23, prices will decline a little bit, and we'll get to that in a minute. We do expect prices to remain, margins to remain kind of close to current levels for both renewable diesel and biodiesel, although we think renewable diesel probably sticks a little bit closer to the current level, and we kind of have biodiesel tailing off into the end of next year before falling. In the first quarter anyway, that's largely driven by reductions in both energy values and some credit values, in particular the RIN value, but then they start to kind of build back up through the year as you get relatively steady feedstock prices and maybe a little bit better recovery in energy prices, and a recovery in RIN prices too. Okay, our RIN forecast only made kind of minor changes this week from where we've been. I think we're a little bit higher in December. You can see the spread between the D4 and the D6 remains relatively wide, and I'm going to kind of do this and show you the LCFS forecast, which is not really, it's unchanged, and again probably 65-ish through the end of the year, and then down to 50 in 2023 before the changes that CARB is reviewing for the LCFS program are potentially implemented in 2024, and then we probably get a rebound in credit prices. Hard to tell how much that rebound would be until we know more about the changes that CARB will implement. Okay, so the last thing that I wanted to talk about today was the short-term energy outlook and its implication for renewable diesel and biodiesel production, and the value of RINs. And so if you looked at the short-term energy forecast from the EIA, you notice that they have cut their forecast for ethanol or gasoline consumption and diesel consumption, and they have cut their forecast for ethanol production and renewable diesel and biodiesel production as well. All of that just sort of generally sounds like it kind of offsets and leaves us basically sort of where we were. But if you start to really dig into the numbers, I think that what has happened in gasoline consumption and ethanol production in particular is why we're starting to see the spread between the D4 and the D6 widen a little bit. Because remember, while the mandates are announced in gallon terms, in individual terms, they're set on a percentage basis of the fuel that's blended. And so a reduction in gasoline consumption across the US means that individual RVOs, renewable volume obligations, go down, and effectively the 15 billion gallon mandate falls. So if you look at the changes that the EIA made to the short-term energy outlook, it looks like there is a marginal reduction in the gap between expected ethanol production and the implied ethanol mandate. Now, it's very hard to figure out because we don't have all the individual RVOs, and so saying with 100% certainty this is the exact impact of the changes the EIA made is a little bit difficult. However, it does look at sort of first glance, a little bit more than first glance, but it does look like there probably is a situation where there's going to be overproduction in D4 and D5 RINs, more in D4 than D5. And that is going to help offset some of that gap in the D6 RINs. Now, we've been expecting this, and we've talked a lot about this, about how we're going to need to overproduce in renewable diesel and in biodiesel to make up for the ethanol gap. But now we're close enough to the end of the year to where we can, again, we can't do it down to the gallon, but we can start to get a sense of what that actually is going to look like. And based on the numbers and based on the changes that the EIA made, it looks like we're probably in better shape than I thought we might be at this point in the year. So that argues that we may not need a huge surge in renewable diesel production in December. Now, I still think we probably will get sort of the same, you know, let me reshare my screen actually. I still think that we'll get sort of the same kind of seasonal increase that we see at the end of the year, but I don't know that I won't be lowering my forecast for renewable diesel and biodiesel production in the coming weeks, particularly after we get the EMTS data on Thursday. I probably will go through and look at all of this pretty closely. And that may mean that I cut that renewable diesel production number down a little bit. A lot of it will depend on a deeper look at the short-term energy outlook and sort of what that implies for the ethanol gap. And it will also depend on what we get for production in September. As you can see from the chart, we kind of have renewable diesel production relatively flat over the next couple of months. Similarly, we've got biodiesel production relatively flat over the next couple of months. For renewable diesel, it does seem like the decline in LCFS credit prices has kind of made it so that not all of the renewable diesel capacity that is online is necessarily profitable when LCFS credit prices are at $65. And that's why we haven't continued to crank out record month after record month, despite some significant increases in capacity, or at least the capacity that's been reported by the EIA, renewable diesel capacity. So I think September will tell us a lot, both about sort of what's going on with renewable diesel capacity utilization and what the end of the year will look like. I also think it will kind of give us the same sort of insight into biodiesel. Biodiesel is a kind of a whole different animal because margins are at record levels, and so biodiesel producers should be producing as much as they possibly can, given the fact that they probably only have another year or so to remain open, unless they're either a particularly large biodiesel plant or they're integrated with a crusher. But after that, it seems like margins probably are going to tighten to the point where a lot of biodiesel producers are going to have to figure out what they're going to do with their facilities. And so while we've got, again, production relatively steady over the next couple of months, the September data will probably give a better indication of what the trend is going to be like into the end of the year. Now, if the gasoline consumption numbers that the EIA put out in the short-term energy outlook turn out to be accurate, and we need to adjust production down for biodiesel and renewable diesel because the gap between the ethanol production and the ethanol mandate is smaller than we thought, I probably would favor cutting renewable diesel production, my calendar year renewable diesel production forecast, more than my calendar year biodiesel production forecast, just because biodiesel margins are so strong, and again, they have a relatively short shelf life for their facilities. Obviously, renewable diesel producers are making more per gallon than biodiesel producers, and so typically I think you would think, well, if you're going to cut, then maybe you will cut biodiesel, and you'll start to rationalize some of that capacity and expand renewable diesel production a little bit. But I have a feeling I'm going to end up sort of going the other way. Again, a lot of it will depend on exactly what the EPA says for September, and then what the short-term energy outlook implies. All right, with that, wow, I've started to drag you people here for a whole hour. All right, if nobody has any questions, then I will wrap this up, and I will see you all again next week. Thanks so much for attending. Really appreciate it, and hope everybody has a great week, and that I see you back here next week. All right, thanks everybody. Have a great week. Bye-bye.